So it's very likely we are like first and goal of hitting a recession with like inches to go. And I saw this picture today and it kind of reminded me of what I feel like we're in, the situation we're in today. And imagine this being like a few people in the government and then these being like 100-ton barriers where their weight's starting to shift and the government's trying to hold them up, but they're about to get smushed. And I just saw this. I thought it was like a funny imagery of kind of what's going on today. But what I want to show you is a bunch of graphs, and I want you to see that something's off through the data, right? So there's some of these graphs I'm going to kind of explain in detail, and then some of these graphs I just want to show you, and you can just tell something's majorly off here because there's things happening right now that have not even come close to happening before. So let's go over some of these things. Let's start with the 30-year fixed rate mortgage average in the United States. So if we look at this graph, at first sight, it looks like nothing majorly off here, right? You say, Greg, well, right now, we're in 2022. This goes from the year behind. We're at a 5.34% rate. We've been as high as 16.64. We're not in a bad area here, so what's off here? Well, if I change this graph and I go to percent change from a year ago, holy smokes, we see the biggest change by far that we've ever seen in the past, in the recorded history, probably the past 50 years or so I have here, going from -5 all the way up to 80. Right, which is an 85% change. Now, the closest change I could find coming off that was this one from 14 down to -13, which is a 27% change, okay? This is still 3 times more than that. The next biggest one was right here where we went from 21 to -4 pretty much, which is like 25% change. Again, over 3 times the size of that. And those were changes down. This is a change going up. Now, the highest change up I could find was this one right here from -17 up to about 9, which is, what do we got, 17, 9, 26% change. Again, this is still 3 times higher than that. So there's a lot of reasons I could go into why this change is happening so quickly, but the major thing I want you to see with this particular graph is that something is majorly off here. And we're going to follow that up with some other graphs to come. So let's go over the net worth for households in the United States over the past, since 1988. Okay. And again, when you look at this graph, you don't see anything that's too alarming here, right? I mean, it's pretty much a constant trend up. If you put a straight line through here, it'd be like a nice straight line. And there'd be nothing bad here. You even have a big upwards movement here. So what's the problem? Well, if we change this to percent change from a year ago, we see something very interesting, okay? We see a major drop here. You got from 19 to 2, which is a 17% change, okay? The biggest change we saw before that was from 5 to -7, which is a 12% change. And noticed what followed that 12% change going down. The great economic collapse in 2008, right, which was a major, major recession. That only went down 12%. This one went down 17%. Okay, look at this other one, right? From 8 down to about 1, that's a 7% change down. What followed that? A recession in 2002. Now another one here, a drop from 9 down to about 5, only a 4% change, and again, a recession followed that one. But you see, a drop here of 7 with a pretty good sized recession following, a drop of 12 with a big recession following. Now we got a drop of 17. A little scary there, right? So just a pretty big sign that something big is coming. Now, we did have a recession here in 2020 with no drop before pretty much, but that was the pandemic, which is a totally different situation because it kind of hit out of nowhere, and that was just a lot different. So a lot different scenario. So now let's go to the yield curve inversion, which is known as probably the biggest factor of determining recessions, right? And people use this all the time. It's probably the biggest thing that's used to determine if a recession is coming. And we see that when we go below this line right here, typically what follows is a recession. Okay, and that's the simple way of explaining this. You see, we go below the line here, a recession follows. We go below the line again, a recession follows. Below the line here, a recession follows. Below the line here, recession follows. Below the line here, a recession follows. Now, we are way below this line here. Again, likely what's going to happen is a recession is going to follow. And if you combine this, especially with this chart here, again, I don't want to go too far into the mortgage rate stuff because we go down a rabbit hole with that. But if you go down to this chart that we went over in the second one, where we're going over, the household net worth average and the percent going down, this drop majorly scares me. This is something a lot of people don't talk about. I've actually seen no one else talk about this percent change from a year ago. and these percent changes, the recessions following those, we've had the biggest one yet in the past, since 88, in the past, 40 years, 30, 40 years. And it's much bigger than the one that followed previous to 2008, right? So that is pretty concerning. Followed by this yield curve inversion chart. It's pretty telling of what's going on. There's a lot more of these charts that show signs like this, but these are some of the major ones that I wanted to show you of just something's not right. But I want to show you some other charts, okay? And I want to show you some things. So I got some images here. And let's just go over, first we'll start with the US dollar devaluation chart, okay? So if you aren't aware, so this is the US dollar devaluation chart going from 1910 all the way up to 2015, okay? And what you see is, you see a little bit of an increase kind of here, right? Then you see a big increase starting right here. So what happened? Well, what happened was in 1944, they started Bretton Woods, okay, which is a major change in the economic system, where basically, gold was set at a price of $35 per ounce, and, the U.S. made some moves where they kind of were like the currency of the world, and the problem with Bretton Woods was that there was never a reserve ratio set for what the U.S. could spend, right? So the U.S. didn't have to have a certain amount of gold backing what they spent. Whereas, before in history, when monetary systems work, if you spend $100, you have $100 in gold backing it. Well, when Bretton Woods was started, again, there was no reserve ratio started, so the U.S. could start spending all this money without the gold to back it up. So in 1971, what happened was the U.S. kind of got found out, right? And what happened was that people started realizing that the U.S. didn't have the gold to back up its receipts, right? So people started asking for their gold back in exchange for U.S. dollars. Well, basically what happened is that Nixon had to put an end to the Bretton Woods system, and they started basically a worldwide fiat currency system. That means that at this point, they could basically print as much money as they wanted with nothing backing it, right? They totally went away from the gold standard. And that's why you see in 1971, the US dollar devaluation chart went up on a exponential rate here, pretty much like a straight line up, or a 45-degree angle, however you want to call it, even a little higher, because the US started printing more and more money. So now I want to bring you to this chart on the historical debt of the United States. This goes all the way back from 1790 to 2022, okay? So as you can see, from 1790, which is basically like the start of the United States, all the way up until this range right here, there was virtually no debt, right? And then, of course, this was around when Bretton Woods started, and we started having a little bit of debt, right? Like, Bretton Woods wasn't a horrible system, but the problem was, I believe one of the problems was there was no reserve ratio set, so the United States started printing more money than we actually had, because there was, we didn't have the gold to back it. And that's where the debt started going up a little bit here. Now, where it really went up is when Bretton Woods ended, and their whole world went on a fiat currency system, where there was nothing backing our dollars, right? Or nothing backing the currencies around the world, which means everyone could just print currency with nothing backing it. They just, out of thin air, just print money. Well, that's when the debt really started going up. So I want to take you to a chart that kind of compacts these numbers, right? So this one goes back to about 1960 or so. We know before 1960, there was virtually no debt, right? All the way back to when the United States started, there was no debt. Well, started getting a little debt through Bretton Woods. Then when 1971 hit, that debt started going up faster and faster and faster and faster and faster. And we see that it's going up even more so now. So what I want to do is take this to Microsoft Paint and just show you some lines here. All right, so now that I'm in Paint, I just want to show you some lines. So from about 1960 to about Bretton Woods hit, we had pretty much a straight line here, right? So it went up a little bit. You see a little bit of curve there, but not much, okay? Then from Bretton Woods up to about, I don't know, the year 2002 or so, we had a little bit of a curve, right? So we'll do a yellow one for that. Sorry, I wanted a green one there. So with this one, we notice this one is starting to go up a little bit, okay? All the way until we hit about right here. Okay, so we have that straight line there. So this one goes up a slight little bit. This one's starting to go up more and more. Now, from about 2008 to about 2020, we're starting to go a little higher. So what's happening is these lines of debt are starting to go higher and higher. They're starting to grow at a faster and faster rate. They're growing exponentially. Now, from 2019 to 2022, holy smokes. Look how vertical this line is starting to get. Notice how this one's almost flat. This one's about a 10 to 15% degree angle. This one's about a 20-25%. This one's about a 45% degree angle. What that means is that our debt is going up like this. It's doing like a hockey stick movement where it's growing exponentially. The problem is, as our debt goes up, there's more and more money in our world, in our system, which means, and the more money there is with nothing backing it, of course, well, that means inflation. Okay. A lot of people think of inflation as prices of products going up, but really inflation is, or prices of, products going up is really a side effect of inflation. And that is because all this money is getting put into the system, and the more money there is in the system, the less valuable our dollars are. So what's happening as we get more and more debt is the value of our dollars are dropping more and more and more. And I can bring up this chart here, this first chart, the US dollar devaluation chart, and it shows like we had pretty much no devaluation before 1910, right? Because it stayed. And then when 1913 hit, guess what that was?
What is it?
That was the start of the Federal Reserve, right? Oh, so we started getting US dollar devaluation when the Federal Reserve started. How convenient, right? Who, by the way, is who prints a lot of money. So you see in 1913, we start getting that US dollar devaluation, right? Now in 1944, when Bretton Woods goes into place, it goes up a little more. When 1971 hits, when the Bretton Woods was ended and there's no gold-backed currency, nothing backing it, we just print as much money as we want for the most part, holy smokes, the US dollar devaluation goes through the roof. And again, we're on that exponential chart here. So my point is we are very close to a recession, but possibly something much bigger. Now, the reason I think we are coming up to something much bigger is this right here, right? So this total debt is just totally out of control and skyrocketing again at an exponential rate. You can see this is a hockey stick curve where we are basically out of control right now, okay? And there's no way to control it. It's virtually impossible to pay off all the debt we have right now. Guess what? This has happened before. Okay, this has happened many times in history. And you want to know what happens during those times? Well, typically what happens is gold evens things out. Precious metals even things out. People realize there needs to be a valuable commodity that backs our money, and it offsets each other, and the prices of gold and silver, precious metals, rise tremendously. And it's happened many times throughout history. That's why I believe we can be very close to something happening very big in the precious metals niche. But this video is more about a recession coming, so I'm going to leave it at that. If you're interested in learning more about investing in gold, I recommend you go to investingingold.com/quiz. We'll hook you up with a company that we highly recommend and highly trust and work with ourselves. And you can find a company to help you learn more about investing in gold and precious metals. So I'm going to end it at that. Just know I think we're inches away from a recession. You've seen all the data to prove it. We're in a very scary time, and I think these graphs just kind of prove that. So I'll see you all in the next video.